Sukumar, what a delight to have you back on ET Now. Thank you for joining us. Sukumar, now there is no mystery in why markets are correcting. We are getting twisted from all the sides, locally and globally. But my question is not why we are correcting. My question is, how much more do you think we will correct?
It's as you know, Nikunj, it's always tough to say, what will be the level of correction, because once the sentiment worsens and the markets become undervalued, it's always possible that they become more undervalued before reaching fair levels. But what we as value investors, what we need to keep in mind is that the intrinsic value of stocks are look like in general they are much higher compared to today's prices. So I think the margin of safety has increased for investors, and hopefully that should be a good enough reason for people to look at many stocks in the market very actively.
Globally, to your mind, Sukumar, what exactly are markets pricing in? At these levels, are markets pricing in a disorderly exit of Greece from EU?
So I don't think people have the ability to really evaluate what exactly is going to be the impact of Greek exit on the cash flows of companies. I suspect that it's not going to be anywhere as close to what has been priced in. So I would say that the markets, at least the equity markets, seem to be pricing in a very pessimistic scenario. I think companies to some extent can get impacted because of the impasse. There can be some slowdown in the major European economies because of the fear psychosis. But I think the stock prices are factoring in a very steep impact on the financials of companies, which I don't think is going to be true.
But globally, Greece is a disaster. France and Germany, they are not talking to each other. US economic data of late has been poor. And China, for the first time in many years, has admitted that they are also now feeling the heat of a slowdown. So do you think at global level, global growth scare is back?
We had very heady growth between, let's say, 2004 and 2007. So I think we have to keep in mind, those are abnormal growth levels. It's clearly not sustainable. And if you look at the reasons for slowdown in various economies, I think there are different reasons. So unfortunately, all these things seem to be occurring at the same time. So that's, it looks like there is a lot of interconnectivity between the slowdown, but in truth, the slowdown in different parts of the world might be due to different reasons, and they are occurring at this time simultaneously. If you look at China, I think it is very clear that the levels of growth that they had over the last 10 to 15 years, that was not sustainable because a lot of growth came from the housing and the construction boom, and that level of building activity obviously cannot be sustained forever. And as construction and fixed asset investment slows down in China, it is affecting the Chinese growth. It's not that the consumption in China has slowed down materially. I think it continues to be at a fairly healthy clip. And exports from China has not slowed down very meaningfully either. So it's the construction activity which is having a big impact on the Chinese growth rates on the margin. So the different parts of the world have different reasons for slowing down. Yes, there is some common effect of all the currency issues and the state of the financial markets, etc. But there are reasons why other reasons why the individual economies are slowing down. The take away from evaluating companies' future is that there are periods of fast growth, there are going to be periods of slower growth. So we have to make reasonable projections for individual companies and countries. And if we do that, I think there is reason to believe that there is a lot of value, because the markets are already putting in low levels of cash flow growth into stock prices, and there's a very good chance that over the next 10-20 years the companies might produce cash flows much higher than what is being imputed in the stock prices at this point of time.
So Kumar, I'll split my next question into two. First, do you think the current decline in rupee is on expected lines given the kind of fiscal mess we are in? And do you think for Indian markets to bottom out, rupee also has to bottom out?
There is going to be some correlation between the outlook on rupee and money coming into the market in the short term, because even value investors who see value in the market, they would like to see some stability in the currency before they start committing higher levels. So some stability would definitely be welcome. So when it's going to happen is tough to say, and at what level it's going to happen, it's again tough to say. But it looks like the rupee movement has been overdone, and so sooner than later we should see the rupee either stabilizing or probably even appreciating a bit compared to the current levels.
Kumar, if I map the institutional activity for this calendar year, domestic institutional investors by and large they have been net sellers, and foreign institutional investors have pumped in about $8 billion. And despite $8 billion, Sensex is at sub 16,000 and Nifty is at sub 5,000. What if they start selling?
So I think the net, the more important issue is that the demand for equity is not strong enough compared to the potential supply. We have been seeing quite a bit of government disinvestment, and also there are companies which might want to raise capital. And so the demand for Indian equities has not been strong enough. So I think that is a key issue.
So Kumar, you have the view that at current juncture, the risk-reward ratio is in favor of going long. So what's been your portfolio strategy of late? For this calendar year, are you in a buy mode or are you still in a sell mode?
So we have believed that we should be fully invested unless we think the markets are overvalued. So we are almost fully invested, because we have believed that the markets are either reasonably valued or undervalued in the last few quarters, depending on the level. As far as whether the composition of portfolio has changed materially because of change in the currency outlook or the currency level or what has happened elsewhere in the world, I don't think so. We still like many of our top holdings, and we don't see a very material change to our portfolio because of what has happened in the recent past.
So let's discuss some individual sectors or businesses you are bullish on. Infosys Technologies, you've liked that stock, you've owned that stock for last 15 years. But now the management commentary from Infosys versus what TCS or HCL Technologies have indicated was poor, and there seems to be a reluctance towards buying Infosys now. What makes you bullish on that stock?
I think the concern about Infosys is based on the short-term performance in terms of revenues, etc. So we have to understand that quarter to quarter performance can vary from company to company. There are periods when the other companies had bad patches as well. So they cannot be extrapolated infinitely into the future. So the basic issue is whether Infosys is a strong company in terms of their product offering to the clients, and we believe that it's a strong company. They offer very good range of services to the companies, and they, I think, offer value. And our speaking to some of the end clients and some of the other people involved in the buying decision seems to indicate that it's still a good company to do business with. So I don't think long-term fundamentals have changed very materially. At the same time, we have to keep evaluating any company in our portfolio on a continuous basis, and we are doing that. And so far, we haven't found any reason to believe that there has been any big change in the long-term outlook.
Do you worry about your exposure to telecom, given the way how dynamics for the telecom sector are moving, and in the light of what TRAI has recommended for 2G auction?
Actually, the state of things that have happened should improve the positioning of the top 2 or 3 companies, because if the reserve price for the spectrum is going to be higher, it's going to make most of the the companies unviable. So over a period of time, the top 3 or 4 companies would be able to improve their market share, and they would also be able to price the products according to what they're going to price for, pay for spectrum over a period of time. So we think that from a medium to long-term point of view, there can be market share increases and margins staying here or improving from the current levels for a period of time. So I would think that the long-term thesis for the top 3 companies has improved because of what has happened.
So you're not worried about your exposure to Bharti?
I mean, the stock has been impacted, so it's impacted the portfolio negatively, but we have to live with these type of things.
What is driving consumer stocks? Lack of options? The markets are of the view that in the near term, global uncertainty will prevail and it's time to hide in consumer names?
Consumer names, I think the value in the names has not improved. The intrinsic value of these companies should be where they are. There's no major assumption that has changed. But at the same time, they have appreciated in price. So the price compared to intrinsic value has become more adverse for the consumer names compared to the other names in the market.
But is it time now to book out of consumer names because inflation is high, high interest rates are eating into savings, and I'm saying out of personal experience that salary levels in the last 2 or 3 years, they've been stagnant.
I wouldn't say that it's, one should be negative on the consumer names. But if people can take risk, they might be able to find more value elsewhere.
You prepared to take more risk?
I think it varies from portfolio to portfolio and portfolio manager to portfolio manager. So, it depends on the characteristic of a portfolio. So, I think where there's room to take higher risk, yes, I think we should.
So at Franklin Templeton, how do you propose one should play the Great India Consumption theme? Buy banks, which are a proxy to consumer growth, buy consumer names or FMCG companies which touch the consumer, or play it indirectly via autos?
See, basically, we don't believe that we need to play any team. We are here to provide good returns for the investors, and wherever we can find good risk return ratio, I think that's where we should be exposing the portfolios to. So we do find opportunities in financials, because financials have generally underperformed. And within financials, we believe that the private sector banks will structurally do much better compared to the state-owned banks, both in terms of market share as well as growth and margins and return on capital. So we have adequate exposure to some of the private sector banks, and of course they do benefit from consumption as well as investing, because they do lend to the corporate sector as well.